Welcome to the deep dive. Today, we're really getting into the foundations, you could say, of the American housing market. We're analyzing D.R. Horton, ticker DHI, America's largest home builder. Now, the environment they're working in, it's pretty brutal right now if you're looking to buy, you know this. High rates, big affordability challenges, and just general caution out there. Yet DHI isn't just treading water, they're actually pushing for more market share. So our mission today is to unpack D.R. Horton's strategy. How do they juggle these aggressive prices, this huge reliance on buyer incentives, and still pull off strong financial returns in such a volatile market? Let's dive into this material.
Yeah, and when you first look at DHI, the thing that just jumps out is the sheer scale. I mean, they just finished their 24th year in a row as the biggest builder by volume in the U.S. That's not just growth, it's, well, market dominance.
24 years, wow. That kind of consistency, it really suggests a very effective, maybe even rigid business model, doesn't it?
It really does. So for fiscal 2025, they closed, get this, 84,863 homes. And the main financials, they really confirm that strength, despite the headwinds. Consolidated revenues hit $34.3 billion. Pre-tax income was $4.7 billion. But the number that I think really captures their efficiency is the home building pre-tax return on inventory, the ROI.
Go, let's pause there. ROI. Could you quickly explain for the listener why that specific metric, hitting 20.1% for the year, is so important for a home builder like DHI?
Sure. ROI basically tells you how fast they turn their invested capital, the money tied up in land and houses under construction, into profit, hitting over 20%. That signals really exceptional capital efficiency, high operational speed. It means they're squeezing maximum productivity out of every dollar they put into lumber, concrete, land, you name it.
Okay. And that strong ROI, it fuels their main strategy, right?
Yeah.
Which has to be affordability. That's the hot topic. How do they keep selling homes when rates are so high and that monthly payment is just huge for buyers?
Yeah, their whole game is volume driven by value. And that means they have to control the price tag. So the average sales price, the ASP, for homes they closed in Q4 was $365,600.
Right, and that figure is the key differentiator, isn't it? It's not just a number, it's a deliberate strategy. The source material shows that's actually down 9% from their peak price back in 2022, which was over $400,000.
Exactly. And this gives them a massive edge competitively. If you compare that $365,600 to the wider U.S. market, DHI's average price is around $140,000 less than the average new home price. That's almost 30% lower, and it's even a solid $65,000 lower than the median existing home price.
So their product strategy is basically engineered to hit that affordability ceiling. We see it in the data. 72% of all homes they closed in fiscal 25 were priced under $400K. And they're managing costs by, well, shrinking the product a bit. The average square footage is down to 1,954 square feet now. Proactive cost management.
And that volume strategy, it seems to be working, at least in terms of maintaining demand. Despite all the consumer caution, net sales orders actually went up 5% in Q4 compared to the year before. That's 20,078 homes ordered.
Okay, but that order growth isn't exactly organic, is it? We know it's heavily supported by incentives.
Well, absolutely. It's entirely fueled by incentives. And that is really a critical point here. Incentives are the main tool for closing sales today. In Q4, a huge 73% of their total closings got some kind of mortgage rate buydown, often getting rates down as low as, say, 3.99%. They're solving for the monthly payment. That's what the buyer really focuses on.
But relying on that many buydowns, 73%, doesn't that put a major strain on long-term margins? If nearly 3/4 of your sales need that kind of subsidy, you're kind of trading future profit for today's volume, right? Is that seen as sustainable?
Well, their current thinking seems to be that it's just the necessary cost of doing business to maintain that market share dominance. They believe their efficiency, their cost controls on the construction side can kind of absorb this pressure. It's a calculated risk, a trade-off.
We should probably also mention the cancellation rate. It went up to 20% in Q4. That's up from 17% in Q3. Now, the company says this is, and I quote, in line with our historical average. But hold on. If they're offering these aggressive incentives and still 1 in 5 deals fall through, and that rate is climbing, does that really sound in line or acceptable in this high-rate world?
That's a really good question. I mean, yes, DHI is a volume player. Their model naturally has a higher cancellation risk than, say, a custom builder.
Yeah.
But that jump from 17% to 20% sequentially and just the 20% level itself, it's definitely something to keep an eye on. It suggests that even with those helpful mortgage rates, some buyers are either struggling to qualify fully or maybe their financial confidence is just eroding between signing the contract and actually closing.
And we see that uncertainty reflected geographically too, right? They've mentioned some softness specifically in parts of Florida, Jacksonville, Southwest Florida, and California, but then better stability in the Midwest and Mid-Atlantic.
Right. And that national scale helps DHI absorb those local bumps. Volatility often hits areas with maybe higher inventory or higher land prices harder.
Mhm.
So DHI's diversification is really key there.
All right, let's shift gears then. Let's look at the direct impact of this price-sensitive, incentive-heavy approach on their actual profitability. Let's talk margins. Their gross profit margin on home sales in Q4 was 20.0%.
Yeah, 20% is still a solid number, but it definitely felt some pressure in Q4. We saw that sequential decrease of 180 basis points.
Okay, let's break that down. Maybe talk percentages for a second, just to make it clearer for the listener. That 180 basis points, that's a 1.8 percentage point drop from Q3, right? Where did that 1.8% go?
The lion's share, 110 basis points or 1.1 percentage points, came directly from those higher incentive costs we were just talking about. They're basically paying more to move the houses.
Okay, that makes sense. And the rest, that came from something less common.
Correct. There was an unusual item that accounted for 60 basis points. That's 0.6 percentage points of the drop. It was higher than normal litigation costs. And the company was pretty quick to say they don't expect that specific litigation hit to happen again in Q1 of fiscal 26.
But should we just take their word for it on that those costs won't repeat? That's 0.6% they're just assuming disappears. Seems a bit, I don't know, optimistic given how complex construction and legal stuff can be.
No, you're right. It absolutely needs scrutiny. If you were to adjust for that litigation cost, what analysts call looking at it pro forma, the underlying margin would have been closer to 20.6%. And that's important because it shows the core business, even with heavy incentives, still has a pretty strong base. But yeah, management's confidence that it won't recur is pretty crucial for them hitting their future targets.
Which brings us neatly to their guidance for Q1 2026. They're forecasting gross margin to be flat to slightly up, somewhere between 20.0% and 20.5%. That range suggests they're definitely factoring in continued high incentive use.
They really have to. They're acknowledging that incentives are just going to be the price of admission for volume growth in 2026.
Yeah.
And that puts even more pressure on their operating costs, specifically SG&A, that's sales, general, and administrative expenses.
Right. And their SG&A management seems pretty tight, doesn't it?
Yeah, it's efficient. Home building SG&A was only 8.3% of revenues for the whole year. That's pretty good control, especially when you consider they actually expanded their footprint, grew their community count by 13%. They're really leveraging that huge national infrastructure they have.
Okay, so SG&A efficiency is key because cost inflation is still biting on the input side. Let's look at costs. What can they control versus what they can't? What's the construction cost picture look like now?
Well, the stick and brick costs, that's their term for the actual vertical construction per square foot, were basically flat from Q3 to Q4. But the real headache is land. Lot costs went up 3% just from Q3, and they're up 8% compared to a year ago.
Wow. That land cost piece is proving really sticky, as they say.
Extremely sticky. And they expect lot costs to stay that way over the next year. So this means DHI's main focus for fiscal 26 has got to be pushing down those stick and brick costs to try and offset that land inflation. They think they need to find cost cuts in the range of 3% to 5% on vertical construction just to keep the overall cost picture balanced and protect that 20% margin target.
3% to 5%. That's a pretty significant target for cost savings. Okay, shifting from cost control to operational control, let's talk inventory. They deliberately slowed down their construction starts in Q4.
Yeah, that was an intentional move. They only started about 14,600 homes in Q4. It was really designed to sort of right-size their inventory levels after things got a bit volatile.
And what was the result of that discipline?
Well, total homes in inventory dropped pretty substantially, down 21% from a year ago. They ended fiscal 25 with 29,600 homes in inventory, and about 19,600 of those were unsold spec homes.
And this reduction, fundamentally, it's made possible by improvements in their production speed.
Yes. This is where that efficiency really comes into play, the cycle time improvement.
Exactly. The median cycle times, so the time from starting construction to closing the sale, it actually decreased by a week just from Q3, and it's down 2 weeks from a year ago. That speed is really powerful. Faster construction means less capital tied up in unfinished homes, which, supports that strong ROI we talked about earlier. Build faster, carry less inventory risk.
Okay, so now that they've trimmed the inventory, DHI is planning to ramp up its starts pace again in the first half of fiscal 26, getting ready for that critical spring selling season. But all this production, it needs a huge land pipeline, What's their total lot position look like?
It's massive. They control about 592,000 lots in total. But what's really interesting here is their strategic approach. It's very asset light. Okay, let's define that for the listener. What does asset light mean when we're talking about land for home building, and why is that better for their finances?
Right. So asset light here means they avoid tying up billions of dollars owning vast tracts of land for potentially years before they build on it. Instead, a huge majority, 75%, which is about 444,900 lots, are controlled through purchase contracts or options. They basically lock up the right to buy the land, but only actually purchase it when they're ready to start digging foundations. Only about 25% of their total lot supply is actually owned outright. This strategy drastically de-risks their balance sheet if land values were to fall, and it frees up enormous amounts of cash for other things like, well, returning it to shareholders.
And this asset-light approach leans heavily on Forestar, their majority-owned land development company, right?
Exactly. Forestar is absolutely vital to this. In Q4, 65% of all the homes DHI closed were built on lots that were developed either by Forestar or by another third party. This integrated reliance on contracted land supports that capital-efficient model and lets them pivot faster if market conditions change.
We also saw them continuing their strategy of making these smaller sort of tuck-in acquisitions, like that SK Builders deal in South Carolina they did just after the fiscal year ended. That helps them grab market share quicker using their existing setup, right?
Yeah, that's pure platform leverage. They buy an established local builder, plug them immediately into the DHI Forestar system, the capital structure, the supply chain, and boom, they can compete much more effectively on price and volume almost overnight.
Let's talk about that capital then. This company generated, what, $3.4 billion in cash just from operations in fiscal 2025 alone? That's a lot of cash. How are they using it?
Their philosophy on shareholder returns is incredibly disciplined. Get this. Over the last 5 years, they generated $11 billion in operating cash flow. And they returned all of it, every single dollar, back to shareholders through dividends and share buybacks.
$11 billion over 5 years, all return.
Yeah.
Well, that's a serious commitment to efficiency and giving capital back. They bought back $4.3 billion of their own stock just in fiscal 25, cutting their outstanding share count by a huge 9%.
And for investors focused on income, the board reinforced this by declaring a new quarterly dividend of Euro 45 cents per share. That's a 13% increase on an annualized basis. Fiscal 26 will actually be their 12th year in a row of growing that dividend.
Okay, so we've seen the success in 2025. What's DHI guiding for the year ahead, fiscal 2026? Are they expecting things to really accelerate, or is it more like a continuation of this stable, incentive-fueled growth pattern?
It looks more like stable, modest growth.
Yeah.
Their key targets include consolidated revenues between $33.5 billion and $35.0 billion, and homes closed between 86,000 and 88,000. That's just a small increase over 2025. They also expect to generate at least $3.0 billion in cash flow from operations.
And their plan for returning capital to shareholders seems to line up perfectly with that cash flow projection.
Yeah, it does, yeah. They're planning for about $2.5 billion in stock buybacks and another $500 million in dividends. That totals $3 billion, right in line with expected cash flow and their mandate. They also plan to keep their consolidated leverage, their debt level, around 20% long-term. They ended fiscal 25 at 19.8%, so that shows they've got financial flexibility to handle these sticky interest rates.
Okay, let's try and wrap this up. If we recap the core D.R. Horton strategy, it seems to be all about driving market share growth by hammering on affordability. They sacrifice some pricing power using massive incentives, and they make that work through really impressive production efficiency and that very disciplined, asset-light land control. Is that a fair summary?
I think that perfectly captures the trade-offs they're navigating. But, this raises a really important question for you, the listener, to think about as we close this deep dive. DHI's entire model really hinges on delivering that affordable monthly payment. We noted lot costs are staying sticky. Management is basically betting they can achieve those 3% to 5% cost reductions in stick and brick construction next year to hold on to their 20% gross margins. Now, if they can't get those construction cost savings, they'll face a tough choice. Either sacrifice that critical 20% margin threshold or ease up on the heavy mortgage rate buydowns. And in a high-rate environment, easing up on incentives probably means sacrificing volume growth. So the question for you to consider is, which variable do you think gives way first? Is it DHI's ability to cut construction costs? Is it their commitment to that 20% margin? Or is it their aggressive growth target? Something's likely got to give.